My name is Stephen Murchison. I'm advisor to the Governor of the Bank of Canada, and for those of you who don't know, the Bank of Canada is Canada's central bank. So we've been talking a lot about central banks this afternoon. And I'm also chair of the Financial Innovation Network of the Financial Stability Board. So the question, I guess there are a few questions. So this is the board and monetary policy for a decentralized currency. How should a global central bank and monetary policy be designed and governed? So I guess my first reaction was, before you start talking about the how, you would want to spend some time thinking about the why. Why would this be a desirable setup? And some of that has already been discussed earlier this afternoon. But I think the way I sort of approach a problem like this is, I think there are very good reasons why individual countries or blocks of countries in the case of the euro area maintain sovereign currencies and therefore sovereign monetary policies. And I think the main rationale for that, I think there's a sort of a sovereign nationalistic aspect to it, but I think more concretely, the main rationale is that different countries respond differently to different economic developments. So for instance, movements in oil prices, a rise in oil prices is beneficial for some countries and pushes inflation in one direction, and has the opposite effect for other countries, depending on whether you're a net importer or a net exporter of oil. So that's an example of where it's highly beneficial to have a sovereign, independent monetary policy. So any system that's contemplating moving to a highly centralized global system, whether it be on a blockchain, or whether it be a sort of a traditional central bank, I think what we're really talking about here is like a single global currency, and therefore a single monetary policy. And I think that in a setup like that, you're going to lose that ability to respond to shocks in the appropriate way that's appropriate for your particular jurisdiction. So I guess, right off the bat, I think that's a pretty compelling reason to think very, very carefully before moving in the direction of a more centralized or more global currency. I think that we've seen with countries that fix their exchange rates, we've seen what can happen when countries do that, where the country that's fixing is affected by shocks differently than the country to which they're fixing to, and you can get all sorts of perverse outcomes. And so I think that the idea of individual countries or blocks pursuing price stability for their own jurisdiction is probably the best way to go. That's the first point. I think just as a more practical matter, and again, this is revisiting some of the points that have been made earlier on. When we talk about, if we're talking about a cryptocurrency as this sort of global currency, so sort of getting rid of sovereign currencies and moving to sort of a global blockchain-based cryptocurrency, I think that nobody can predict the future, but I guess I look at it from the vantage point of what I observe right now, and I would argue, and I should have prefaced all of this by saying these are my own views and not the views of the Bank of Canada or the FSB, but my own view is that what we've observed to date is that cryptocurrencies being traded and operating in mainly advanced economies where they have credible, independent monetary policy frameworks with price stability as the main objective of monetary policy, I don't think that you can consider cryptocurrencies money at this point in time. And it really goes back to the, Nouriel laid it out much more dynamically than I could, but there are these sort of three roles of money, and the stable store of value, the unit of account, and the means of payment. And I think right now, what we're observing is a little bit of a catch-22 situation, in the sense that there's reluctance to accept it on the part of merchants because of the price volatility, and because it is not an established unit of account. So if I'm a merchant who's accepting cryptocurrency, what I care about is ultimately how much I'm going to get in US dollars or Canadian dollars or UK pounds. What people ultimately care about when they're taking receipt of this Bitcoin is what they're going to be able to purchase with it. And that is still, the unit of account is still sovereign currencies. So as a result of that, this price volatility matters a great deal. I mean, I think if cryptocurrencies became established as more of a unit of account, then these wild movements in Bitcoin vis-a-vis sovereign currencies obviously wouldn't matter as much, and you would probably have less of that volatility. But I think right now we're sort of in a catch-22, because you've got these scalability issues, because you've got price volatility. Now that's not to say, I mean, I don't take what I consider to be sort of the extreme view that Nouriel has taken, that you would want to sort of rule this out as, well, if we can't do it perfectly right now, then we should just forget the whole idea, because we'll never be able to do it in the future. I mean, I think there are, and I think some of the other panelists are gonna talk about some promising areas of future work that are aimed at reducing that price volatility, which in turn could help it to serve, in principle, more as a means of payment, and therefore potentially as a store of value. My point is that I don't think we're there yet. Last point I'll just make very quickly. I think that the way that central bank digital currency has been characterized this afternoon is one of a possible set of options. And I think what has been discussed, which is basically, you move all consumer deposits onto the central bank's balance sheet via an account system. And so you in fact completely disintermediate the deposit-taking credit creation component of private banks. I think that's an extreme view of what CBDC could be. And there are certainly much more middle-of-the-road sort of approaches that I think central banks are currently investigating. So one option is, rather than having an account-based system where essentially anyone in the public who wants to have an account at the central bank does, instead you have more of a tokenized system whereby, much like cash currently gets distributed through the banking system, you would have CBDC distributed through the banking system. So in effect, a private bank could simply demand more settlement balances, which people could then, and that is central bank money. People would then have the option of, say, using an app to move money from their demand deposit into central bank currency, and it would be held locally on your smartphone or on a card or some sort of technology like that. And certainly there could be a role for the private sector in terms of developing the interface that allows, through an API, that allows people to make that transfer from their demand deposit to central bank money. The key point is that once it's on your phone, it becomes central bank money. Private banks no longer have access to it to loan it out. It is no longer considered inside money. And I think that's a much less sort of disruptive sort of intermediate between the sort of two extremes of the status quo and the sort of full Monty CBDC that Nouriel took us through, that would be much less disruptive and would have much lower risks of sort of disintermediating private banks and moving the whole sort of role of keeping track of accounts, KYC, credit creation, and moving that all to the central bank. So I think there are solutions that sort of exist in the middle, and I'll stop there.
Okay, my name is Ansgar Belke. I'm a Jean Monnet professor for macroeconomics at the University of Essen. At the same time, research associate at the Center for European Policy Studies, where I also took part in the monetary experts panel in the European Parliament and could observe all the difficulties the ECB had in coping with too low inflation. Negative interest rates could not be implemented. QE was ineffective, as we argue, also for the US in terms of lowering long-term rates. So in my mind, I think the question, at least, how should a global central bank be designed, is a kind of misleading. I grew up with Robert Mundell, 1999, Nobel lecture on, more or less it's time for the mundo, the global currency, because all inflation rates have converged. They have not, as we see. So what I miss a bit also in the cryptocurrency debate, focus on optimum currency areas. So my ideal view would be a three-polar world with three optimal, more or less optimal currency regions. And within that, maybe a competition among cryptocurrencies and official monetary policies. And as we heard this morning and yesterday as well, the central banks are in a stronger position, but still, if central banks do not deliver stability, this might be a chance for cryptocurrencies, at least for countries with weak institutions. So let me just elaborate a bit on the second question on how currency supply could be regulated, and maybe later on deal with a roadmap for the stable currency. So what is obvious is that high volatility is explained by the lack of trading pairs, which we have. So many of the cryptocurrencies have low trading volumes, strong volatility of demand, and much of it is driven by the underlying blockchain technology, the fiat to crypto exchange rate volatility. So the pegging also of the cryptocurrencies to Bitcoin is another source of the volatility which we have to deal with. But if we now go for a higher number of fiat to crypto trading pairs, and if this is gradually increasing, there might be a desynchronization in the development of the values of cryptocurrencies, and the hedging function might be completed. And this is what I would like to argue, that this kind of cryptocurrency investments would serve as a hedge for other investment risks and play a productive role in overall risk management. So in principle, they provide an opportunity to diversify and to hedge against movements in other currencies and asset markets. But if the cryptocurrencies' values become more stable with respect to some traditional currencies, I would like to argue that this would lead to a closer match with the respective traditional currencies, so a decrease in its usefulness. So they become more or less similar also to the currencies. There might be also the possibility to improve the supply protocols. I'm not an expert in that. To limit the volatility of the currency values. More responsive to demand conditions. This might be a way out. And we heard already several times of the stable coins. The creators of the new currency called Basis, and there were other representatives around, arguing that it's rather simple to provide a currency to which the supply can expand and contract in order to stabilize and to maintain a stable value relative to an official currency. Again, it might be better to have a currency related to particular homogeneous jurisdiction and not tie the supply directly to the consumer price index or so. This might be preferable. We can discuss this. And I think also in terms of cryptocurrencies, regarding cryptocurrencies, that they are inherently vulnerable to changes in beliefs and expectations, like other currencies. So in spite of any sophisticated protocol, there's no reason to believe that there is an equilibrium with stable prices which will always prevail over the unstable equilibria. And also, we are not allowed to forget that central bank managed currencies have other properties that help establish their acceptability and their function as a guide to economic agents, as there are legal tender. Second, they are a means of settling taxes. This must be introduced in order to stabilize any cryptocurrency regime. And I think that central banks really benefit from several decades of price stability experience. Gold supporters always argue that the purchasing power of the dollar or so is only 4% as compared to 100 years ago. But if you look at the inflation rates implied, more or less 3%, this is not dramatic. So the performance is not as bad. So what would be the approaches to regulation? And then I conclude my first intervention. I think that cryptocurrencies could serve as a vehicle to protect assets against theft or repressive confiscation, so they increase systemic competition and eventually financial stability as well. This I would admit. But I'm not an expert on that. Current technology is still a limiting factor. So we could speak here of a system of last resort instead of a lender of last resort, where cryptocurrencies work as a fallback option, and they should stay in competition with the other currencies. Regulation should also be careful to account for diversity and the evolution in rapidly changing environments, which we saw here at the conference, and not unnecessarily restrain wealth creation by this kind of competitive process. I think also that increasing transparency and investor awareness should be a priority. And also some trading practices which were discussed by Rubini and others. They have been banned in the traditional financial system. They are alive on crypto exchanges, as I understood. So we should look at institutional actors before they enter the market. This is what Rubini also argued. Yeah, and we need that banks account for the risks associated with the exposure to cryptocurrencies. There are interrelations between both systems, and there is no reason to assume that the fractional banking system will disappear after cryptocurrencies or digital currencies dominate. So I think the multiplier effect, this was also asked in the questions, would become larger even to that extent, and we have to regulate this. And finally, I think I'm coming from a country, by the way, where we have a very strict banking act, and this banking act, the German Financial Services Supervisory Authority, the BaFin, does not classify Bitcoin as money. This is different, for instance, in Austria or the Czech Republic. And if I look at other price-stable cryptocurrencies with an algorithmic central bank, these are refuted by Eichengreen and others on specific reasons. For instance, if you have platforms which have to grow in order to function, so doubts about the future would undermine stability now, and this is well known from the literature on speculative attacks. So I conclude here. Thank you.
Yeah, I would like to continue the dialogue. And I am somehow more pessimistic about the prospect of a stable global cryptocurrency managed somehow by a global central bank. So let me presume that there will be such a moment that the cryptocurrency will be globalized and will have a weight which will be significant enough to make it an intriguing question. So I'd like to argue that there are fundamental differences between stabilizing a national currency versus stabilizing such a crypto global currency. If you're looking at the way that stable national currencies are managed today, inflation targeting is the way that seems to work. But this is not automatic. This is assuming that the central bank is independent and is managed in a competent way. So if you wish, the central bank is the owner of the currency, in the sense that this is the charter of the governor, and he is responsible for this, and the independence is supposed to give him enough tools. And we know that it seemed to work. Now, the cryptocurrency, along the line that we are thinking, will suffer from what sometimes we call the tragedy of the commons. And the reason is that by definition, a decentralized currency is not owned by anybody, if this is the vision of something like cryptocurrency. It's collectively owned by an amorphic collection of all the potential users. Now, this led to the question, how to control the supply, who is controlling this, and to what degree there is a way to manage the supply to match the demand. Now, because there is no clear owner, so it's not clear who will do it. Now, then, if you are looking more fundamentally at the possibility that maybe the market will do it. So we know in the past history of the US, before the formation of the Fed, there was a time that there was a reason to worry about financial instability, and then among the largest banks, or the larger bank, decided to function as the one that will deliver greater stability. Now, because of the nature of cryptocurrency, we don't have the ability to identify who is the party that will have vested interest. And furthermore, if such a party is a big unknown party that has market clout, that party may not have the incentives of the large private bank in the US that intervene in stabilizing the environment, because in fact such a party may benefit from using its market clout to manipulate the market. And we know that there are ways, if you have market clout, and especially if you can coordinate your market clout with maybe other whales, i.e. agents that have large positions, there is a way to benefit privately from manipulating the pricing. So if you wish, the stability of a currency is a public good. And that's the reason why I believe over time, evolutionary forces and political forces led us to the convergence to national currencies that by now are following mostly inflation targeting, and I would say in 80% of the countries that are doing it, they are delivering the desired stability. Now, in the case of the vision of globalized cryptocurrency, we don't have any clear-cut ownership. The insiders that are called by now whales, and I understand that 40% of the global supply is controlled by several hundreds, it's not clear who they are, and if I'm one of them, I don't think that I'll act as the agent of stabilizing it. Unlike the example in the US, that the largest bank, everybody knew the position of the largest bank, and the largest bank had the responsibility of doing it. So this leads me to the speculation that there is no escape from this tragedy of the commons, and if and when there will be something like globalized cryptocurrency, there must be a way to think about not asking the market to do it, the market is not going to do it. Now, if you are looking at any vision of centralized global currency, now it's very hard to think about anything that accomplishes this. The IMF has this SDR currency, which is synthetic currency. It's a non-starter because no transactions really are executed. And even at the level of the IMF, we know that coordinating among the three big blocs, i.e. the US, the emerging Eurozone, the EU, and China, is very hard, almost impossible mission. So again, even in the context of national currencies, coordination of global stability is something that is an open to challenges. If you recall, the Bretton Woods system attempted to, from the get-go, to generate some coordination to minimize exposure to runaway current account surpluses or deficits, and it didn't work out, despite some ideas of Mr. Keynes that was there. So the bottom line, I am skeptical due to two fundamental reasons. First, I doubt if the nation state will tolerate the arrival of the moment where a cryptocurrency will challenge the national currencies. Like it or not, the state has the apparatus of preventing it. Now, even if we are reaching this point, the tragedy of the commons suggests to me that without thinking about a different layer of currency, which will be not cryptocurrency, but will be transparent enough such that the ownership of the big parties that will play the role will be clear, I don't see why the market will do it. In the same way that the market is not stabilizing the stock valuation of IBM, why the insiders that are the big owners of the stock of IBM should stabilize it? The answer is they are not doing it. Why should they do it for crypto? I don't see a simple resolution for this.
Excuse me, maybe I may introduce one question, because I'm missing something.
Yes.
As a democratic single person, why should I trust all your money systems and banking systems? And where is my right as a person who has worked for his assets that you take me the opportunity with your opinions and your position to decide it myself where I would like to put and park my assets and my values in it? I think you're on a very high level talking about, but missing the people of this globe and their interest as well. And please maybe discuss it.
Okay, do I have the time to answer? Yeah. You see, the issue is not what is my private view or your private view, because nobody is asking me what is my view about cryptocurrency or about the dollar. Okay? I'm doing research on these issues. So I'm not telling you my views. I'm telling you the outcome of, I think, credible research that is telling me that you should look for a market mechanism that will deliver it. Now, I don't know what is the meaning of the global citizen that we heard about it. I'm not a global citizen. I don't think that you are. I'm a citizen of Lilac, a country or countries that gave me citizenship. Now, my ability to do what I'm doing is anchored not by my views, by the nature of the system that I'm stuck in. Had I been in China, the Chinese authorities will not ask my views. So I am unable to answer you why we are living in such a universe, but the point is the nation state is one of the organizations that seem to be scalable in the sense that they are living in 3 blocks that are approaching big scale. Each block is 20% of the global economy. Now, I understand the wish to have a cryptocurrency. And my answer is not because I believe that it's right or wrong. I believe that a successful cryptocurrency that will challenge these 3 blocks with a lag will deliver the private destruction of its capacities by the 3 blocks. Now, I made a point earlier. I don't appreciate what is happening in China. But nobody in China is asking my views and not your views and not the views of the Chinese authorities. Living in the US, I can tell you the following. A successful cryptocurrency will reduce the capacity of the central bank to conduct monetary policy, and it will reduce the capacity of the fiscal authorities to conduct fiscal policies, because most of us will pay much less taxes because we don't have the incentive to report honestly. Now, I don't envision that any functioning state will tolerate such an assault on its capacities to tax. And my view is that if in Europe we are paying, say, 25% and more of our income to the authorities, we expect them to guarantee financial stability, and if there is a run on the banking system, they will intervene. Like it or not, I don't see the end of the nation state, not because I like it or not, that's life. So this leads me to raise the question, do we have any trajectory that will imply that in the 3 blocks there will be convergence to global cryptocurrency? I'm skeptical. And my answer to this is the state is scalable in the sense that, at least in the US, the state is commanding super large computers. IBM is coming now with quantum computers. IBM is not too far away from the state. We talked about the internet. The internet was the outcome of ARPANET and some evolution that started at the Pentagon. if China or the US would like to kill the crypto system, I believe that within a year or two can be done. It's not because I'm supporting this or not. It's irrelevant. So in the absence of any vision of seeing the end of the nation state, and notice that it's scalable, because 60% of the global economy is controlled by 3 bodies. The EU with the euro is still a collection of states, but in terms of dealing with the crypto threat or not, we have the ECB, we have one central bank. So this is a long answer to make it the point. It's not my view and not your view, not because you are wrong or I'm wrong. The nation state is the potent, like it or not.
So I'm happy to also follow up a bit. Just to introduce myself, my name is Ariel Zeitlin-Jones. I'm a professor of economics at the Tepper School of Business at Carnegie Mellon University. My research as an academic is mostly in understanding how financial markets work. Fintech, especially blockchain, is a great example of new innovations in financial markets because it merges technology with economics and economic incentives. And so perhaps an answer to your question that's slightly different is, imagine this panel were described as how would you develop the best possible cryptocurrency? And then if you want to take that advice and run with it and try to implement it, I say go ahead. And maybe our research can shed some light on that. I would step back and phrase the question, and I'm closer to Stephen's perspective on this. There's a real challenge with cryptocurrencies. So instead of thinking of designing a pure currency, we step back and ask, how can we design a useful distributed ledger? How do we design a useful blockchain? And because that ledger is maintained and has to be agreed upon by a decentralized network of users, we have to incentivize consensus and maintenance of that ledger. And that's where economic incentives plays a key role. And this isn't new, right? This is all forms of money emerge as a form of economic incentives to bridge gaps in trust. It's just a new technology for obtaining trust where it previously didn't exist. And so the take I want to ask is, one way we could ask this question is, what is the best way to design a protocol to provide the most efficient incentives for consensus and maintenance on a distributed ledger? Bitcoin pursued one approach, which is we're going to use these tokens, and the designer decided to have them issued in a fixed supply. Now, one of the challenges with the consensus ledger is the same consensus that agrees on the information on the ledger determines agreement on the protocols underlying that ledger. So it's actually very hard to change the underlying protocols. So as a designer of a new blockchain, you might ask, if I get to design it and release it to the wild, I shouldn't really expect those rules to change all that much. So I take the challenge of Valentin's question here to be, what are the right rules to establish for a new blockchain that could be more viable, that could be a global cryptocurrency for the world, that serves as this payment mechanism, okay? That's efficient. It's efficient in the sense that it provides a stable means of payment, okay? We know its real value in terms of goods and services, and it provides the right incentives for maintenance of this ledger. This is the dual challenge you have to resolve here, okay? And I think for that, honestly, we need more experts in computer science, more experts in cryptography, more experts in economics who understand the incentive problems that are at work in doing blockchain design. And before we can ask, how do we design a smart contract? How do we optimally provision for the release of new tokens? I think we need to know what is the real value in the underlying protocols. Because a lot of protocol design choices impact the economic security associated with tokens, okay? Protocol design choices impact the value of a 51% attack, if you will. Okay, my analogy is the protocols are like the walls of a safe, and I don't think we really know how thick the walls of Bitcoin's protocol safe are. But we know as the value in the safe is growing, as the value of Bitcoin transactions grow, the incentives of people to try to break into that safe are going to grow as well. So I think what a lot of academics are trying to do is understand, and we're a bit behind in the game, as academics are wont to be relative to all of you industry folks. But we're trying to start with something that's well understood, say proof of work, and better understand what's the thickness of the wall of the safe provided by proof of work, and how do we improve upon that? And then we'll try to keep up with you on all of your new distributed ledger consensus protocol mechanisms to figure that out, okay? And the last point I want to make about, there's this view that Joshua provided that says, I don't think central banks will cede control of their currency to emerging cryptocurrencies. you might take a very different perspective. We have a history of central banks ceding control of their money supply, using currency boards, exchange rate pegs, and adopting monetary policy of other countries. So I think it's likely we could see currencies, and not just in a PR way, saying I'm adopting a cryptocurrency, but countries actually turning to cryptocurrencies to issue rules of their monetary policy to take control of monetary policy out of their hands. So as benevolent as we think of governments as economists all the time, we might think they face their own problems. The key one academics have really studied is limited commitment. Governments have a hard time committing to a long-term path of monetary policy. They have very strong incentives to re-optimize after the fact and take advantage of what people have done. But if I issue my monetary policy on a blockchain, the rules of my monetary policy are now governed by the users of my blockchain. Okay, it's feasible for me to design that algorithm in a way where I don't have a lever to start changing the policy after the fact. And to the extent that buys commitment, that could be quite valuable. Okay. One might argue, and I have in some of my ongoing research, that this commitment could be a key role in implementing stable coins. So in the sense of designing an efficient cryptocurrency that's pegged to some other reserve asset. Doing so requires a very complicated path of exchange rates, and how you would commit to do that could be quite a challenge. But if I can announce, create, and code this as a smart contract, then I can implement that in a straightforward fashion on blockchain. So I think there's a lot of promise for governments, existing governments, to use this to resolve commitment frictions.
Hello, my name is Linda Schilling. I work as an assistant professor at Ecole Polytechnique in Paris. And I would like to introduce you a little bit to my work with my co-author Ariel in Chicago, because I think what we've been working on is really at the core of what's been going on here. So what we did is we looked at cryptocurrency pricing under competition to other fiat money, such for instance the dollar or the euro, in a macro context. So the idea is you have a cryptocurrency, which I just, for simplification, will call Bitcoin. And this cryptocurrency competes for usage with, let's call it the dollar, okay? So what I mean is that people can decide on their own whether they want to purchase using dollars or Bitcoins, and producers of goods can decide whether they want to sell using Bitcoins or dollars, okay? So the one key aspect in the setting is that there is a central bank which controls the dollar price level through the dollar supply, but has no control over the Bitcoin price evolution, okay? And so the question that we've been addressing in this setting is, what can we say about the crypto price evolution, given that crypto prices will have to change in a way such that the demand for goods is equal to the supply, okay? And I think that's an important question because, from the perspective of a central bank, cryptocurrencies are like, they're entering the money market. So central banks used to be the monopoly for providing money in the economy. And one of the main targets of central banks is to ensure a certain price level for instance, the dollar, okay? So that we can today buy as much milk as we could buy 2 weeks from now with the same quantity of dollars. Very simplified. And this is achieved through controlling the dollar supply. And central banks did quite a good job in the past, but the theory that I've been using is based on the assumption that central banks are monopolists in providing the money supply, and at the same time they are seeing now transactions happening at the blockchain. So there's huge economic activity, huge demand for cryptocurrencies, employing cryptocurrencies to purchase something, okay? Which means from the perspective of a central bank that there's demand for a currency which is not the currency that they themselves supply, okay? So there is a provider of currency or provision of currency which they themselves do not satisfy. This means in response that central banks right now have an awareness that they do not control the entire money supply, meaning that potentially they cannot ensure the dollar price level the way as they used to, okay? And this is exactly where our theory comes in. So what we basically predict, it's a theory model. It still needs to be taken to the data, but what the model says is that we can, or the central bank will still be able to control the dollar price level through the dollar supply, but it will be much more complicated because the central bank will need to adapt the dollar supply to the currency supply and to currency prices, okay, cryptocurrency prices. And now that's good and bad news at the same time, because it's bad news because they constantly have to be looking what's the crypto supply, what are the crypto prices, and so on. But the good news is that we can perfectly see the crypto supply evolving through time. It's previsible. Okay, we see the block rewards. And we can also observe prices. So this means from a central bank perspective, basically, the question, can central banks still control the dollar price level through the dollar supply, is answered. The answer is yes. And the question is, will it stop there? So remember, central banks used to be monopolists, and now there's entry into the market of crypto, of currencies as a whole. So someone who used to have a monopoly always has an incentive to defend the monopoly position. And this is where I'm exactly also with Lawrence, right? So the idea is there's competition for currency right now going on. Central banks had the monopoly. They have an incentive to defend this position. And yeah, what I want to say is that, you know, it is true that from a monetary perspective, Bitcoin has no value, but the dollar doesn't have value either, right? So that's fiat money. That's how we define it. And from a monetary perspective, as a monetary theorist, that's always the question: does money have value at all? Okay, and so how should monetary policy look like? It's establishing trust, and apparently right now, trust, like price stability alone, doesn't seem to be the same as trust, right? That's what I want to say. I will finish here. So.
Thank you.
If I might give a small, more technical perspective.
Sure.
Cryptocurrency, if anything, has to deal with code, with programming, with information flow. And there have been developments over the past several decades that are basic but haven't really transferred over. When there are parties that do not speak with each other, parties that do not talk to each other, parties that do not trust each other really, programs on computers run through application programming interfaces, APIs. So you can have defined entry points, defined exit points. You poke an API one way, you know you'll get a predictable response. I think that looking to cryptocurrency to satisfy certain conditions of central banks when it's not clear what the API is of the central bank is a fool's errand. And how is it realistic to get the central banks to make a well-defined standard of a cryptocurrency that does X, Y, Z will have this response from us? And then the people who want to have the relationship with the central bank have that interactivity, to have that ability to move money in and out, and have that relationship with the central bank, make the cryptocurrency to satisfy it. Because right now, as I understand it, central banks aren't giving guidance to the cryptocurrencies so that people who are designing these things can have a reliable response from the banks and say, okay, well, this cryptocurrency is going to be legal in 34 states because you know what the APIs are, and we're going to design it that way. I think that a lot of the burden of governments, a lot of the burden of these institutions like central banks, they're trying to put it on the innovator side, whereas it may be more proper to say, well, you've got some nice, interesting experiments here. If you want to play with me, just here's what you have to do.
I can provide tentative answer. I believe that the long-run survival of cryptocurrency is conditional on having such a dialogue. I think it's possible to do it, but then you should understand the challenge facing the state. Now, you emphasized the monopoly power of the central bank. It's really linked to the monopoly power of the state. Because look at the US. The FDIC is supposed to bail out banks. But the FDIC is not the branch, really, of the central bank. It's really the branch of the Treasury. Because if you look at the end, the full fate of the FDIC belongs to the Treasury, such that if the need will arise, the Treasury will support the FDIC. So here, there is the issue of the ownership. And the nation state will say, in such a dialogue, if there is financial instability propagated by the cryptocurrency market, the state will be the agent, and I'm referring to the Eurozone and the US and China. The state, the Treasury, is the agent that will participate in potential bailout. Who is participating in this? So this is part of the problem of the ownership. Presently, the evolution of the cryptocurrency was spontaneous without any attempt of anybody to coordinate with the state, because this was the logic of decentralization. But here, the point that I'm making is this logic is clashing the interests of the state, not only because there's a monopoly having power, because we are not talking now about Argentina or Venezuela, we are talking about quasi-democratic systems like the US and the EU, where if there is a financial crisis like the Great Depression, we know who will bail out. Now, if the crisis will be contributed by the cryptocurrency dynamics, we need to know what will be the haircut of the contribution of whoever that is there to the bailout. And there is no dialogue about this, implying that before having this, I'm skeptical about the scalability of cryptocurrency because of all these issues. So I agree with you that we need more dialogue, and I'm happy that in the Bank of Canada and other central banks, people are thinking about this. But it will take a long time to reach a consensus and a evolutionary.
I think that, to clarify, I'm not talking about a dialogue. I'm talking about laying out an API is not an act of dialogue. It's a unilateral act. You don't have to wait to get 3,000 cryptocurrencies to agree. You just say, this is what you need to do to get me to do X.
But who is me? Are we talking about all the central banks? No, but we are talking about three global central banks.
The Treasury Department, all of the necessary players who are institutional, if they have a clear message and they say, if you want me to recognize you as money, this is what you need to do. If you want me to recognize you for unit of account purpose, this is what you need to do. And lay out your position. You don't have to get the herd of cats that is crypto into one direction. That's not going to happen. You just have to say what you believe in, but you're not. The banks aren't, the national governments aren't, and it drives people who are like me, who are trying to be a bridge between the Wild West and the more regulated environment. It's a huge challenge.
I agree, but I'm not sure if the dialogue, when it will start, will be, and it started in China. They tell you, we don't believe in cryptocurrency, which is not allowing us to identify the agent. So you heard the dialogue from China. Time will tell what will be the reply from the EU, from the Eurozone and the US.
I don't think...
China, as you're taking China and comparing it with the democracy. If you are living in a democracy, democratic rights, and this is also the rights of the people are important, be defended. You are going for this and say you want to have it worldwide. So it's not depending what China as a non-democratic country is doing. It's more about what you are doing for the people in your democracies and what you want to, what they want and what their aims. And you cannot sit there and say, we decide about anything. You should also listen to the people and what their concerns.
I agree fully. Start a party of the cryptocurrency and try to push it through the democratic system. So there is nothing that prevents you. Now think about my dear leader. I'm doubtful how he will react, but it's up to you. The problem is that the democratic system is not voting on crypto. Typically, we have 2 or 3 parties that are bundling everything together. To my knowledge, it's not because I like it or not, we don't have any party that I know that has significant clout that is representing the interest of the crypto sector. So you may argue that you don't like the democratic system in Europe.
Switzerland, the people at least voted in this direction because it's a liberal country, decentralized. Liechtenstein is voting. US cannot always say the rest of the world how we can vote and what you're doing and put the power on it. And I think there we should really come to think that you also accept that people on this planet want something and want to develop it. This is a huge movement here, and that you should face it and make a bridge instead of saying that I don't believe in it or we don't believe in it and we don't want to have it.
My answer is, you're right, but let us agree that Switzerland is not the global citizen. Because chances are that if I apply for citizenship in Switzerland, I'm not going to get it. Now, we heard about the notion of virtual citizenship. It's irrelevant. What you are saying may be correct for Switzerland. Go ahead with this. If you try to do it in the US, the odds of success, in my view, is close to 0. In the EU, Eurozone, close to 0. So good for you. You're living in a country that your view, according to what you are saying, counts. That's fine. Now, the open question is, can you force China, the EU, and the US to accept your views? The answer is no. Not because I like it or not.
Can I just come back to the original question for a couple of minutes? So I think it's a good question. I guess I would turn it around and rather than saying, sort of what do central banks want from cryptocurrencies or cryptocurrency creators in order to be sort of granted legitimacy, which I think was sort of what your question was. So first of all, I think that when the G20 has come out and said, these cryptocurrencies in their current form are not money, they do not fulfill the requirements of money, and that's why we're going to refer to them as crypto assets rather than cryptocurrencies. I mean, I don't interpret that as a bias or sort of a pejorative statement. Rather, I think it's just a description of what we're actually observing. And what we're actually observing is that when you look at the role of money as a means of payment and as a stable store of value, you cannot associate those two things with cryptocurrencies. Very few vendors accept Bitcoin relative to more traditional forms of payment. We've talked about price volatility as being sufficiently prevalent that you can't really think about it. It's more of a speculative asset at this point rather than a stable store of value, and it's not a unit of account. People don't think about the price of something in Bitcoin. They think about it in their sovereign currency and then do the conversion. So I would turn it around and say, when cryptocurrencies solve these issues, when cryptocurrencies actually gain ubiquity in terms of being accepted as a common means of payment for online purchases, for in-store purchases and things like that, then I think they will be regulated more as money, as opposed to the way they're being regulated right now, which is a little bit more like securities.
Just to clarify, when I'm saying to create an API, it's not just cryptocurrencies, because other innovations that perhaps haven't even been conceived yet, once you have an API, once you have a set of rules, that this is what you need to be stably in account, this is the highest level of volatility, you have one objective standard, and it's highly important
Yeah, so you're you're looking for a quantitative definition, like actual numerical thresholds.
Because you act on them. You may not say them, but you have a revealed preference. You probably don't take both of our deposits at the moment. It's probably not going to happen next Tuesday either. However, if things play out in a certain way and things get better over there, you may change your mind. You don't say what's going to cause you to change your mind. And it would be really helpful if you started. And that's for national currencies and that's for crypto as well. And having a fair single standard would be extraordinarily a positive thing.
Can I say? So if you,
Things to say, but I will start with this discussion.
Put in the microphone, please.
Yeah. I think, I understand your position. I understand your wish. It makes a lot of sense from the point of view of somebody that wants to develop a cryptocurrency and things like that, and to do the direction of general acceptability as a means of payment. However, when you say to central bankers, you say, you give us an API, you talk as if all the central banks in the world are coordinated with respect to that. But it's an individual. Each central bank may have a different view about that. Okay. So there is the view of the Bank of Canada, there is the view of the Fed, there is the view of the ECB, there is the view of the Bank of England, and there is the view of the Bank of Venezuela. And the Bank of Venezuela really is not the Bank of Venezuela; it's really the government, and the Bolivar and all that. They may have different views. Now, this brings me to the second thing. Why is it, do you think, that the only option to achieve stability in those countries that have unstable currencies, like Venezuela today, like Bolivia, the Bolivar and all that, is only through a cryptocurrency? Yeah, no, but I mean, this was the insinuation because, Yeah, okay, I know, maybe you didn't mean it.
It is actually the reality. Venezuela people prefer to pay in Bitcoin than other currencies.
Okay.
And I know that because I was there.
Uh-huh.
And I can tell you that it's strange that in a country like Venezuela, people it's in US dollar or in Bitcoin and not in Bolivar because you don't make like.
But when. Fine, but let me ask you a question. In Venezuela, do you know if they prefer to accumulate their savings in bitcoins or in US dollars?
Actually, in both. The problem with dollars is that they don't. It's with this high level of criminality. When you have $1,000 at home, it's quite easy to get robbed. And if you have $1,000 in Bitcoin in your private key, it's less. It's safer.
Okay, but this could be achieved, and this is something that's related to something Rubini said during his talk, but maybe was sort of neglected among all these. Let me just finish.
Part of the pension in Venezuela is paid in Petro, the national cryptocurrency. They are not happy about that, but because Petro is a joke, Bitcoin is not a joke.
No, but you see, but another way to achieve this kind of stability and immunity against crime of holding dollars is to have individuals have access to dollar deposits through their iPhones. In other words, and then so if if they're allowed to have dollar deposits, if they're not allowed to have a dollar deposit.
You do realize that holding Federal Reserve notes is a crime in Venezuela.
Yeah, that
Okay.
is the point. Like even to take some dollars, you need to go to the border with Brazil and actually smuggle the money.
Okay, but if this is a crime, the government of Venezuela makes it a crime to hold dollars. Tomorrow, when you start to use bitcoins and the government is not satisfied with that, they are going to decree that using bitcoins is also a crime.
It is a crime. It's just easier to hide.
It's easier to hide, okay. But
We're leaving the area of economics and into the area of political revolution.
Yeah,
These are
but-
acts of rebellion.
Yeah, okay, sure, okay. But then the question is whether when we are talking about devising a system for the world, and my impression was that this is what you were talking about. Let me just finish. Let me just finish the point that you know that we're talking about countries that are reasonably stable. Now, countries in which there are revolutions, in which people are killed, in which there are civil wars, in which there are, like Syria, there are, 500,000 dead because of the civil war, another million wounded, and about 3 million refugees that are running all around the globe trying to get into those. I don't think that, that the problem is not going to be solved by Bitcoin. The problem resides somewhere completely different, and we know where it resides. So this is really, saying the citizens of the world and all that is very nice for zoology, but,
There are real failure modes in the first world.
What?
So,
In
can I-
2013, the United States engaged in a failure mode. The Obama administration started Operation Choke Point and took legal businesses that are completely authorized by U.S. law and tried to shut them out of the banking system. It didn't stop until the Trump administration said, this is crazy. You don't do that.
Can I just,
What kind
can I-
of businesses?
Also, the banks want to take away the cash money. They want to take your cash money away and the full control of it. And for me as a citizen, it's important then to have a currency where I can believe in, which I have also the possibility to do cash payments like the Swiss franc, and they are also going for this. So cryptocurrencies have also in the first world a lot of means which also say we are not happy anymore with the existing banking system and their dominant dictatorship in financial markets. So our stability is always the old grandma we put in the front of the line, but please take in consideration if the banking system, the existing one, would do their job, then maybe cryptocurrencies would not have this impact in the future.
Yes, but Kulok, how do you change the existing banking system? This is through changing the government. Now, how do you change the government? Through the voter. You have to convince.
If I vote in Europe, the European Parliament has nothing to do with the European Commission, and the European Commission and the European Bank is a separate issue, like the Fed in US as well. We have only here in Switzerland and in smaller countries where democracy has a value and the central point that you have really an impact and that there are the changes here. And this is the topic which is also behind all this topic. So if we want to go for peace, freedom and a stable and freedom world, we cannot continue with a system like this, and we need alternatives where people can decide who they are trusted and who they
But
Okay. So hold on. Let me just say two things to this. One, to your point, no one on this panel is going to disagree with you that regulatory uncertainty can depress investment and innovation. Okay, you're absolutely right. I think, though, you're putting a bit of an unfair burden on how we regulate. I shouldn't say we. I am not a central banker. The panel was not central bankers for crypto. It was what would a central bank for crypto look like. But I do say, look at banking code. Banks also face severe amount of regulatory uncertainty. Look at tax code. There's a huge amount of regulatory uncertainty in the U.S. system, at least everywhere. It's not clear there's that much more regulatory uncertainty for new innovations in blockchain versus any other industry. When there are 8 different capital liquidity requirements banks have to satisfy, that alone seems silly, okay? So I'm with you. I agree some certainty would be helpful, but it might be a bit of an unfair burden. There's somewhere in the middle. On the other point, I think it's important to also recognize that one of the reasons certainly bankers will tell you why is there this emergence of cryptocurrency, it's because of what the Fed has been doing with policy. It's because of what banking regulations have done to hamper what banks can do. That the reason we're seeing high prices, the reason they're passing on regulatory costs at typical consumers. So in some sense, what the existing central banks are doing may be playing a role in why we're seeing such demand for innovation outside the traditional financial space. You're talking as if all the central banks are doing is cramping down on this innovation. But the same way we saw central banks maybe spur the shadow banking innovation, perhaps what we've been seeing over the last 7 years is central banks spurring a new type of innovation in blockchain for financial services. So, it's a bit of a double-edged sword in how you're perceiving this. You see it all as negative for blockchain, but it might actually be providing or sowing the seeds for demand for these innovations.
I had placed that construction of APIs because there's a multi-decade history of getting people who don't necessarily even like each other do. They will change their code just to break your stuff. And they promised that, and they've delivered it. So it's not just something that is a burden on the institutions. It's sort of a promise of predictable behavior. When people behave badly, you expect to get your hand slapped and to suffer the consequences. That's what an API does. That's a multi-decade history of how APIs work. When Microsoft tried to knock Unix out of the ability to network with its machines, internationally, a group of computer scientists changed the Kerberos standard 3 times in a week until Microsoft caved in. There's dialogue that can be done, and there's long-standing history in how to have success at it, and how to handle bad behaviors. And I have yet to see evidence of in the crypto world taking that as a model to try to negotiate people who don't really understand each other. They come from different worlds. And that's what I'm trying to say, that it's a complicated story. And I think there are rich lessons available. And I hope that you would consider it.
Thank you. Let's make a small exercise. Imagine that there are 10 million people who has the new currency on their wallets, and the currency is frozen. They have something like 1 trillion of currency, say L. Let's call this L currency. And in some African villages, there are people they're farmers who need seeds. And they don't have money, but they need to kind of plant it. And their neighbors has wallets on La Token Exchange, and they say to them, well, I can give you a loan in this new currency, and there is another neighbor who can sell you seeds. And then you kind of do your work, take harvest, and sell kind of your harvest in this currency, pay back my loan. So there are 4 people involved, and all of them are ready to accept this currency. And there are several villages who started to do like this. But currency is frozen. So how would you release this currency? Imagine there are hundreds, thousands of people are starting to use this currency in this way. How to manage supply for this currency so it is stable? So, and you have a power to unlock currency on their wallets. So there is a smart contract. You can tell to this smart contract, so release some part of the currency on these wallets. How would you? What would you do to bring this currency into circulation?
I think that at least the central bank should intervene in order to prevent pure barter and barter disappointments, this kind of exchange. So this is again an example that you still need some kind of lender of last resort.
In the same way, I would say that recently, some currencies like the dollar or the renminbi have been used as a weapon, trade recognition or political recognition as well. So don't you fear that the cryptocurrency would belong to a central bank, would be used, as you said, truly, to freeze the wallet of certain class of population or countries? It would be easier for them to control the cryptocurrency than the actual dollar trade. Don't you?
This is an exercise that, to a degree, history showed us that at the end of the Second War, Europe was destroyed, and the US this time did something right in the form of Marshall Plan and other plans. So it goes back to the question, what is the political economy story behind this? Sometimes the party will do it right, sometimes not. So if you're going back through the concern of Keynes in 1919, we know that there are ways of doing it wrong, in a wrong way, or better. But at the end, the answer is related to the political configuration and also to the income redistribution aspects, if this is a currency that belongs to a certain segment, and what is the attitude of the sovereign to that segment.
So the political structure is very simple. These peasants do not ask their governments if they can use this currency or not. They just have access to internet. That's it.
I think there's an important design choice in here, though, which is, and this came up when we were discussing central bank digital currencies earlier today, of you embed the government with a lot more power, we should be worried of what they might do with it. If it's a smart contract you're designing, there's a question, should we allow the government to choose a contract that adds or subtracts or freezes individual accounts or not? Once it's written, if it's truly decentralized and implemented by decentralized code, the government doesn't have the opportunity to change it again. Now, maybe you want the government to be able to redistribute to individuals. Maybe there are benefits of redistribution, and maybe there are costs of freezing individual accounts. So economists are going to try to value those. But at a mechanical level, technologically, our new technology allows us to write this in a way that that power is taken away from the government ex post. So even though you give individuals, if you really want to go further, cryptography is pushing us further into zero-knowledge proofs, where the government doesn't even know what's in your central bank digital currency account. The tech cryptography is on its way there. So the question is, you can change the technology if you want, if you're worried about that concern. Is that the optimal thing to do? I don't know. But there are ways to get around that.
This exercise is even more simple. So you are elected board of governors, and you have case, this smart contract, multi-signature. So you make decisions, sign it, and smart contract execute. And this is for a while, maybe for a year or two, and then you will have to approve your decisions with the holders of this currency. For example.
Right.
I would like you to answer your question about a simple question. In my view, this has to do. This is not a transaction that should be viewed as a transaction with money. This is really a credit, a sort of small credit allocation. A small credit allocation is something that I think we agreed, and I second Muriel opinion that he was talking about really, we're talking about central bank digital currency. He was talking about giving the monopoly of the central bank only to about 1% of the total financial assets that have to do with the most liquid kind of thing, which is basically pure currency. Everything else, including the allocation of credit and all that, is going to remain in private hands, and no central bank has to have any rules in touching. And the kind of example that you bring here is basically falls squarely into the area of financial transactions, which are not necessarily have to do with what the exact medium of exchange is. The medium of exchange could be a cryptocurrency, a Bitcoin, or Ethereum, or a coin that has been issued by this or by that. It could be a dollar coin, or it could be just a representation of a dollar bill, or something like that. You don't have to invent, a distributed ledger for that. This is, and if you want, you do that. If the private sector decides that it's more efficient and they like it, like the guy that we just walk away, please do it. The central banks are not going to intervene.
I only to go to the toilet.
You are Swiss, right?
Yes, but German origin.
Okay.
And I mean, just to that point, I mean, if you adopt something like the tokenized system that I was describing earlier, then they don't even have to give up that 1%. I mean, it's currently central banks have a monopoly over the creation of banknotes, and there are versions of central bank digital currency where nothing else really changes except the central bank continues to have a monopoly over the creation of central bank money only. And you have to remember, the vast majority of money in an economy is not central bank money, it's private bank created money. But that share that is central bank money, it would simply go from a banknote, a paper note, to something that's more convenient as the means of payment, and therefore would remain competitive with other electronic means of payment. Because what we're seeing in a lot of countries is a decline in the demand for cash. I know it's not true everywhere, but we're seeing it in a lot of countries where the transactions demand for cash is falling. And as a result of that, central banks are asking the question, well, do we need to replace it with something? Do we need to replace it with something that's more convenient, because people are substituting away from cash because you can't use it to make online purchases. You can't transmit it electronically. So I think there are states of the world where governments could end up, through the issuance of a CBDC, with significantly more information that currently private banks have about you. Private banks currently know a lot about your transactions behavior. Some of that could conceivably shift to central banks. What I'm saying is that's not the only design possibility. There are design possibilities that are much, much more sort of light touch in
This is what we really call the Lagarde plan.
Yeah.
Basically, he actually mentioned that the third possibility, this was not the one that he preferred, but it is the one that I also, like you, I prefer.
And I think, it gets back to the issue of what is sort of the appropriate supply rule if you were in a world with a cryptocurrency. And I think that's an interesting question. I think there are obviously parallels between what central banks have learned in time in terms of what the appropriate instrument of monetary policy should be, that carry over to cryptocurrencies. Because if you imagine a world where you have a ubiquitous cryptocurrency that is used as a means of payment, and you have financial assets that are priced in that cryptocurrency, and you have banks that are lending, taking deposits in cryptocurrency and lending, whatever the platform is, whatever the original money supply rule is that's built into that cryptocurrency, is not actually that rule is not going to control the overall supply of cryptocurrency, because you're going to get the same sort of money multiplier that you get with the creation of inside money in the current system. So I think this idea that somehow a cryptocurrency could perfectly control the outstanding quantity and therefore perfectly control the price level, history has taught us that that's actually not possible. And because you get movements, you get shifts in demand, you can't control what the money multiplier is. The money multiplier changes through time. And so what I would think would end up happening is you would have a cryptocurrency issuer that would wind up with an operating framework that was not that different than from what a current central bank uses, which is an operating range. They control the scarcity of a very, very narrow measure of money, and through that they control short-term interest rates. And that's how they achieve price stability. So there may be parallels between that and sort of the kind of money supply mechanism that you have in mind.
Okay, let's imagine there are two tools for monetary policy. One is to unfreeze frozen tokens on millions of wallets gradually. And second is to give loans, and you can tweak interest rate and also approve who can take loan, who can't.
So you want to figure out a way to get this cryptocurrency into circulation.
Yes. So
I mean, what do central banks do? They accept assets in return for banknotes. That's how central banks, when people talk about central banks printing money, they don't print money and then just give it away. Their balance sheet is made up, is balanced on the asset and the liability side. When they create money, that appears as a liability on their bank sheet, there has to be an offsetting asset. So they accept assets, treasuries or whatever from private banks in exchange for the creation of banknotes. So it seems to me in your setup, you would actually have individuals coming in and saying, look, I have these 6 bushels of wheat. I want to trade that in for some cryptocurrency so that I don't have to engage in barter.
And I don't need his wheat as a pledge. Because
Sorry?
this central bank or this smart contract cannot control this wheat as a pledge.
Cannot control the wheat, just holds it passively. And the person could then redeem their cryptocurrency in exchange for, well, I mean, assuming it wasn't a perishable, assuming it wasn't something perishable, could then, and then you've essentially got an asset-backed cryptocurrency.
I think the question is also, should we allow, and I'm curious to hear your response, should we allow individuals to borrow if we have a central bank digital currency from the central bank?
So,
not just hold reserves, but borrow reserves. Because I think that's Valentin's question, which is, though I don't have the wheat yet, I'm going to produce it. But I think that's the content of the question, is should we be allowed to have negative positions with the central bank?
Why should it?
I had a hunch what your answer was. But
No, but I think all those that are on the other side, so-called other side, including Rubin, I think, including Joshua and all that, they believe like the rest of the audience, that those kinds of activities should be left to the private sector. Whether this is done through a Bitcoin cash or Bitcoin coin or a fiat dollar or a fiat euro, or something like that is a completely different question. But all those kinds of transactions that have to do with small loans, big loans because you have to plant you need seeds in India and things like that. All those things, those are credit. This is financing credit. This is the business of financial institutions. Should be left to private financial institutions.
I think it's, and again, I'm speaking personally, but it's not obvious to me how central banks would have a comparative advantage in the provision of credit. So, and again, I think that this moving away from this sort of account-based system even eliminates that as a potential question.
Okay. Linda, what kind of metrics would you consider to program this smart contract for another year? So you encode the monetary policy into smart contract. What should the smart contract consider to decide how much money to print by unfreezing them or by giving loans perhaps to exchanges?
Okay, so I think I agree with Steve in that the monetary supplies should be just managed as central banks do, right, to maintain price stability. I think central banks have a lot of experience in managing the money supply and achieving price stability. So I think the effective thing to do for a smart contract would be to just copy what the central bank does, supplying money when
Yeah, I think this question is good to add to exams in universities, and I will add it for applications to this board of governors. So, all right. Thanks a lot. It was very insightful. Thank you. Woo.